The following is a paid program, and the views expressed on this show do not represent the views of WJZ-FM, Entercom Communications, its sponsors, or affiliates.
The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers, certified financial planner practitioner and founder of Akers Financial Group. Here with me today is Mark Diorio, Chief Investment Officer of Brookstone Capital Management. Good morning, Mark.
Hi, Brian. Happy to be here.
It's great having you. Mark's been in the financial industry for over 20 years. Mark and I have been working together for more than 6 years, I think it's been. You've been featured in a lot of things like Investors Business Daily and Wall Street Journal. Today, you have many important things to talk to us about, but as a portfolio manager and chief investment officer of one of our portfolio design corporations that we use, we want to really talk with you today about the stock market, about portfolio design, and about where the market's heading. So we welcome you to our show today, Mark. Thank you for coming.
Great. Look forward to it.
All right, I got a first tough question to start out with, and that is this, Mark. Mark Diorio, what is your opinion of what's happened in the first 6 months of 2020?
There's no question it's been a remarkable year. And, if you invest long enough, you're bound to see a lot of different market cycles. But this one was very unique in the fact that it was an exogenous shock, meaning outside of normal economic activity, which really came to impact the market. So the first quarter saw a dramatic decline, but the second quarter saw almost as a remarkable recovery where the market bounced very sharply. And the reason it bounced was not necessarily because of economic activity. As we all know, the economy was still closed for the most part as we made it through the second quarter, but because of the very quick policy response, both fiscal policy and monetary policy. Fiscal policy is executed by the Treasury Department, and that's government spending and some of those stimulus checks that came out. And monetary policy is executed by the Federal Reserve. Now, the Federal Reserve came in very quickly. They don't have to wait for congressional approval to pump money into the system to help stabilize the economy. And to give you an idea, it took 80 weeks for monetary policy really to come in during the global financial crisis of 2008 to 2009. This time around, it took less than 8 weeks to come in. And so far, it's been very sharp. The stimulus efforts really seem to have helped stabilize the economy. And while that's not going to cure a health crisis, what it is going to do is mitigate the financial impact so that the slowdown in the economy or the stopping of business will not amplify those effects, or the financial markets will not amplify the effects of slowing down business. So this is really just a kind of a lifeline to help the economy recover and to let the financial markets smooth out while we go through this transition. So it's a very unique environment where policy response has been so strong. And we think that there is definitely an appetite in Washington on both sides of the aisle to continue with any additional stimulus policies if that comes up.
As you know, Mark, we work with a lot of clients at Akers Financial Group, and we work with different types and styles of portfolio design. We also work with different ages of clients with different objectives. So this kind of market that we've been through this year is just very volatile. And when I hear the stimulus, and it sounds like it was a very good thing in the short run, what's the effect on the long run, these type of Fed changes and things that have happened already this year?
Sure. Well, we already see kind of a much different market environment where some stocks, the stay-at-home stocks or technology stocks, have done very, very well, while some of the more traditional stocks, including financials and energy, haven't done as well or haven't bounced as quickly. So you have really multiple different markets going on. And what's hard is that some of it doesn't make traditional economic sense. where you'd say, well, this doesn't make sense. The economy isn't fully reopened yet. How do we have earnings visibility? How do we know what companies are going to look like in 6 to 12 months, and will earnings come through? So it's really understanding these policy responses and understanding that the money won't get out evenly, the capital allocation won't be as efficient as if the market was up and running, or how the markets had operated previous to this event. So we have kind of this phased-in allocation as money slowly works itself through the markets and through the economy. The longer-term effects, I think, which are extremely important from an investment perspective, is understanding that this is a moment in time, and the stimulus efforts, both by the Fed and the Treasury, with congressional approval on the Treasury side, is done to help stabilize the current environment. The long-term impact is really what happens after this. And what we think is that you have to continue to stay invested during this period, because the likely outcome is that we'll continue to have very low interest rates, and the value of your dollar will slowly depreciate. That's called inflation. Now, we've typically had fairly low inflation recently, except in those key areas that we all use, which is house prices. Let's say just use over the last 20 years, automobiles, college education, and of course, healthcare costs. So all of those we don't think are going away. But you may have the dollar decline in value. So if you're just saving money in a savings account or a CD, you get very minimal interest, and that value of that dollar is just going to slowly decline or depreciate. So one of the main reasons for investing is the preservation of purchasing power over time, and it can't be more important of a time to emphasize that, and understanding that, yes, it's not clear on the economy, but it's still important to have a very diversified, disciplined approach to the markets.
Right. So when we work with our clients, what we do at Acres Financial Group is we design portfolios, and these portfolios are managed actively by Mark DiOrio at Brookstone Capital Management out of Chicago. Mark, you have your MBA, and you're also a CFA?
I am a chartered financial analyst.
That's not a Chick-fil-A expert.
Oh, my kids
CFA.
are.
Yeah, your kids are excellent. Yeah. How many kids do you have, Mark?
I have 3.
Awesome. Congratulations on that.
Thank you.
The markets are tough, and the markets are volatile, and it's been one of those years where there's been a total shutdown of the economy. And when I see the market roar down, like it was just really fast, and then roar back up, it makes me very cautious on, is this a V recovery or a U-shaped recovery or a dead cat bounce? What's your opinion on the basic movement of the market over the first 6 months of this year?
I would separate 2 things, the market response and the economy. The market looks like a V shape where it bounced back very sharply, and that's really due to the policy response, so the stimulus response. It's really separating itself from how the economy is going to operate. The economy is going to come back in a phased reopening that we think is going to take much longer than a V-shaped. We hear that sometimes about the economy. Our baseline is a U-shaped, which really just means it's going to take much longer. And I think that's supported by a phased reopening. This is going to be a slow process, and the data would really support that. So there's 2 different things, the markets responding to policy, and then the underlying economy kind of acting in the real world, if you will, of how do you reopen businesses going forward. And it's just going to take some time.
Absolutely, because it's going to take different states, different timelines. It's just everything's going to be, there's no just, we just open the door and we just start working again. It's sort of a conversation. Every company, every city, every state has to decide how they're going to approach it. Some companies have gone bankrupt already, and some of the companies are done incredibly well because there's like a new economy for them.
Definitely, and it's really sped up the adoption of certain technologies, and some in a broad range of disruptive innovation or just new companies, new technologies to use. And I know we use it all the time, and we are right now, of course, meeting with clients and discussing, and even amongst ourselves as professionals, using new technologies at a greater pace than we were before. And then other companies just have different business models, and so they're a little bit more challenged by, and of course restaurants is the obvious one. If they're not at full capacity, they're at partial capacity, and other businesses, and there's different areas or segments of the economy, as you were mentioning, that are going to open at different speeds just because of situations on the ground in those areas. So it's a very nuanced approach, and I don't think you can take one macro view or policy that's going to relate to all companies from C to C, so to speak.
Yeah, this causes many people to react like in a negative way. Have you seen that?
Yeah, we've seen a lot of emotions, and I would say I would be patient. I wouldn't expect the idea of going back to normal. If you start to assume that or have irrational expectations, I think that's when you get into trouble and maybe make poor decisions, especially with investments. We see that all the time. Anytime emotions get involved. And so we'd say take a step back, have reasonable expectations when you approach both the economy and the markets at this time, and not overreact. And the other part of this is there's so many headlines, and we thought the biggest headline of the year was going to be the election. We're not even in that phase yet, and it's mid-year, and so there's going to be a lot of headlines, which makes it hard to decipher what's good or what do you react to in terms of as an investor. And that's where I think working with an advisor and the role that we play is critical in trying to decipher all the different noise and boil it down to the hard objective facts.
Yeah, this leads many people to react in a negative way. The actual word reacting takes energy away from you, makes you defensive. What we want our clients to be doing at Acres Financial is to be creating. We want you to sit up, sit forward. We want you to be creating and have a moving forward energy where you're able to make decisions that help you and your family. We invite you to talk to us at Acres Financial Group to begin winning in retirement. To do that, you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, you leave a voice message, and Susan will call you back on Monday to schedule a phone or video meeting. We look forward to having you come in. We can actually start coming in as long as we wear a mask. So it's not quite the best way to do it. So we are still doing phone, video, and some clients are coming in with the mask meeting inside the offices. So give us a call at 833-946-7384 or go to acresfinancial.com and check out our Facebook page. Dividend stocks are still down. Should you make a change or hold for a better day? This topic and more in a moment.
Imagine you're retired. You wake up in the morning and you don't even know what day it is. Every day seems like a Saturday. You can sleep in, cook a nice full breakfast without thinking about morning traffic or work deadlines. The Saturday calmness you used to crave is now your everyday feeling. You're not worried about your retirement income or how your investments are doing. Your biggest decision that day is where you're going to drink that first cup of coffee. Is that the kind of retirement you want? If it is, then sit down and talk with the team at Acres Financial Group. They want to help you get there. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
Long before 18-year-old Brooks Robinson was signed to play third base, and years before Natty Boh began brewing at the corner of Conkling and O'Donnell Streets, Baltimore families relied on the Evans family and the Evans Funeral Chapel and cremation services to help them during some of their most important family moments. Hi, I'm Charlie Evans, and for 4 generations, my family and I have been there for families, providing care and compassion in their time of need. Evans Funeral Chapel and Cremation Services provides the best facility, staff, and personalized service for your family. We have 3 convenient locations to serve the community: Parkville, Forest Hill, and Hereford. For more information, visit us online at evansfuneralchapel.com or call 410-665-9444. Evans Funeral Chapel and Cremation Services, serving Baltimore families since 1865. I invite your confidence.
Acres Financial Group was founded on the principles of integrity, trust, and service. We believe each and every client is unique and deserves advice and implementations that apply directly towards their personal financial fingerprint. This financial fingerprint tells us the objective risk tolerance and purpose of the investment and insurance tools that we use to assist our clients in reaching their goals. By discovering the purpose of each financial decision, we can help you accomplish your goals. Intelligent financial design starts with a detailed balance sheet and cash flow to know where to start. This leads to a financial decision that will allow you to reach your goals with your risk tolerance in mind. Our relationships begin with an initial consultation and grows with each meeting. We would be thrilled to work with you and begin your planning process. Call us at 833-WIN-RETIRE. That's 833-946-7384. Or visit our website at acresfinancial.com. Member FINRA SIPC.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, President and Founder of Acres Financial Group. Here with me today is Mark DiOrio, Chief Investment Officer at Brookstone Capital Management. Brookstone Capital Management is out of Chicago, and what we do at Acres Financial Group is we do planning with our clients, and we design portfolios, and then we implement those portfolios through money managers like Brookstone Capital Management. And the head person, the Chief Investment Officer at Brookstone Capital Management, is here with us today. You need to listen to what we got going on today. It's a lot of talk. What we try to be for our clients is to be that person that can interpret the brilliant words that come out of portfolio managers and then apply it to our clients, apply it to their investment portfolio, apply it to helping them stay in the market with the investments that should be set aside for risk. So, Mark, are you ready to go for our second segment?
Well, I'm excited. We're talking about dividends, aren't we?
Absolutely. The dividend stocks are still down. Should you make a change or hold for a better day? What do you think about that, Mark?
Well, I think from the previous segment, I mentioned that we think interest rates are going to remain low, and we think lower for longer. And so the income coming from dividends is really at a 50-year high relative to the interest that you would earn on bonds. And so this is a really important source of income. And so these are dividend stocks. And so what a dividend is a direct distribution from your mutual fund, ETF, or stock directly to the shareholder. And with an individual company, dividends are declared by the board of directors of the company based on the conditions of that business, and typically are very stable. And there's an elite group of stocks that traditionally continue to pay dividends with consistent business models that have really treated shareholders well over time. And the important part to understand is the dividends that you receive in dollar terms do not change based on the price of the stock, whether the stock is at $50 a share or $30 a share, or just wiggles around with the market. The dividends are set by the board of directors separately. So it's not subject to the whims of the market and the price of the stock from day to day. There's a number of companies that have consistently paid and raised their dividends on an annual basis to shareholders over decades of time. These are great companies. So when we look at dividend stocks, we think there's a lot of attraction and a lot of reasons to be allocated to them, because you get that dividend income stream, and dividends are always a positive return to shareholders. And so if you go back over time and do a lot of digging over the last 100 years of the stock market, you'll find that dividends account for almost half of the overall return of the long-term stock market averages. So we're looking at, right now, we're looking at companies that haven't rallied like some of the tech stocks that have benefited from this unique environment that we have. These are companies with what we call business moats. And that's a term from Warren Buffett, and he uses that term, and a few other analysts in the industry use that term. And just to suggest that this business is very solid, it's hard to replicate this business. So it has an ability to keep generating cash flow. And a lot of these are big blue chip companies that we all work with in some capacity. Everyone is Coca-Cola, Pepsi, McDonald's, and these aren't recommendations for any one individual stock. Those are more or less the types of stocks that you might find. They're well-known brands, but they're somewhat unappreciated as far as the value for an individual investor to invest in, because you get two components. You get dividends, which are really a payout or a share of the income or earnings that the company has, and they share it with the shareholder, and then raise that dividend over time. So, for example, if you have a company, even going through a 2008, 2009 really bad stock market, if you're just taking your dividends off that portfolio, you wouldn't even know that those stocks were down. It didn't impact your income or your lifestyle at all. And in fact, your income actually rose during that time period. Not too many people can say that, but as a dividend stock shareholder, you can do that. And there's a number of these companies, and we look to put together baskets of these stocks that are high quality, with a consistent track record, and really business models that favor paying out dividends to shareholders.
Right. So when I hear about you talking about dividend stocks, I picture people looking at their portfolio and they're seeing these great names, these great companies that pay good dividends, but they've been down all year. They haven't recovered. And so the more they listen to the news, they all want to buy an investment that's going to go up right away. So people are selling these dividend stocks and looking to buy technology. Is that a good move at this time?
I think understanding that when you do that, you take a big leap in your risk assumption, because a lot of technology stocks do not pay a dividend. So your return is solely based on whether the stock is rising or falling. Where a dividend company, well, you're getting that dividend income stream right away. And sure, the stock goes up and down, but not nearly to the magnitude of those companies that aren't paying a dividend. And so if you look over time, if you look over longer periods of time, companies that don't pay a dividend have a much smaller return, but not necessarily in the short term. So you can have these anomalies of what's in favor in Wall Street for this 6 months, and then it fades back. But history, time and time again, comes back to the dividend payers as being a very consistent return stream. And the other fact is, to get a dividend, you do not have to sell shares of stock. So to generate or get cash from the stock, you can get the dividends, which come in. Each company generally pays on a quarterly basis, for example. So you'd have cash flow coming in every quarter, or generally every month if you diversify by stocks that sometimes some pay in January, February, March, and so on. Whereas if you own a stock that doesn't pay a dividend, the only way to get cash out of there is to sell some stock. And then you get into the point of, well, what do I do during a down market? Now I'm selling shares lower and lower, and you just keep decreasing your ownership. Or if you're owning a good dividend basket, a dividend portfolio, geez, you're really living off those dividends in a sense, and you can keep all those shares that you own.
Right. So at Acres Financial Group, we use Brookstone Capital Management to help invest our clients' money. So one of the pieces we do is we do invest in the Brookstone dividend basket as part of a portfolio. Now, is the word sleeve the proper word when I'm talking about designing an account for a client, where you put a sleeve, meaning a portion in dividend stocks, and we have a portion in something like smart beta, something like that?
That's generally the terminology we've used. What sleeves? Your portfolio could have a few different sleeves or a few different strategies. That makes it all one diversified portfolio. So I think sleeve is a good term.
Right. And so my view of sleeves is that you can have an IRA account, and that IRA account can have multiple different styles of management done, multiple people managing the money for you. Now, at Brookstone, you bring a lot of different things to bear for our clients. Can you explain the concept called smart beta?
Sure. Smart beta is really comes from academia, which says, how do we identify stocks? And a traditional way to identify stocks was, are they large cap stocks or small cap stocks? Just what they sound, large companies or small companies. Are they growth stocks or value stocks? And growth stocks are technology stocks, value stocks are financials and energy, just as an example. But what Smart Beta does is say, well, maybe those aren't the right terms. Maybe we want to look at characteristics of stocks. And so what they've identified over are and there's a lot of academic research on this, but it's really interesting. They say, well, why don't you group stocks by their characteristics? And we call that factors. So one of them is, one area we really like is a factor called minimum or low volatility. What it does is isolate the least volatile stocks in the S&P 500. So instead of owning all 500 companies, you'd own the 100 least volatile stocks. You're still very well diversified. And what research has shown over time is that, interestingly enough, you actually outperform the S&P 500 over time with, importantly, less risk because you have less volatility. And this really turns traditional finance on its head, which would say, well, in order to get more return, you have to take more risk. But in this case, you actually took less risk. You just have more profitable companies is generally what it comes down to. And so the market doesn't question how profitable the company is. They really can value it based on traditional metrics. And so they don't have to move around as much.
Okay, and that's a design called Smart Beta. Beta meaning the risk of a portfolio, and Smart just the design of it, right?
Correct. So Smart was the term they used just to say this was looking at it through a different lens with a lot of academic data to support this Smart Beta idea, really reconstructing the index based on some smart ideas, if you will.
Right. I think that's a really good thing as people are getting close to retirement. A radio show is called Winning in Retirement, and we want our clients to win during those retirement years. But we still have to have some of our money designed to beat inflation after tax over time. So we must design our portfolios in a way that'll provide for now and for your tomorrow by designing portfolios that can weather storms such as we've seen this year. So we invite you to be part of our process at Acres Financial Group. You can begin winning in retirement by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, you can leave a voice message, and Susan will call you back on Monday to schedule a phone, video, or maybe even coming in for a face-to-mask meeting or mask-to-mask meeting at one of our offices in Lutherville and in Harford County. We look forward to when we can do this. We look forward to hearing from you. Go ahead and give us a call at 833-946-7384. You can go to acresfinancial.com, or you can also check us out on Facebook. All right, ESG investing is a hot topic this year. And no, it does not stand for every stock grows. We'll explain what ESG is and how it affects your money when we get back.
Are there times in some games you wish you could just turn on the TV at the 2-minute warning? Because that's the most important part of the game, right? As a fan, these are the most exciting moments. Your team could take home the victory or crumble under pressure. But when it comes to your retirement, don't wait until the last 2 minutes. So much can happen in the final working years before retirement. Whether you're in your 50s or 60s, near or already in retirement, there's still time to put a plan in place. Don't wait until right before you retire to begin planning for your future. Can you win the retirement game like that? Come in and talk with the team at Acres Financial Group. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
Acres Financial Group was founded on the principles of integrity, trust, and service. We believe each and every client is unique and deserves advice and implementations that apply directly towards their personal financial fingerprint. This financial fingerprint tells us the objective risk tolerance and purpose of the investment and insurance tools that we use to assist our clients in reaching their goals. By discovering the purpose of each financial decision, we can help you accomplish your goals. Intelligent financial design starts with a detailed balance sheet and cash flow to know where to start. This leads to a financial decision that will allow you to reach your goals with your risk tolerance in mind. Our relationships begin with an initial consultation and grows with each meeting. We would be thrilled to work with you and begin your planning process. Call us at 833-WIN-RETIRE That's 833-946-7384, or visit our website at acresfinancial.com. Member FINRA SIPC.
The choice of your child's school is vitally important. Wouldn't you go a few more miles for something really special? I'm Brian Wilson, principal of Harford Christian School. Harford Christian is an independent school in northern Harford County, serving students in preschool through 12th grade. Our Uncommon Core makes all the difference. For nearly 50 years, we've partnered with parents in the important responsibility of training children in God's truth. Our biblical worldview stands in stark contrast against today's culture. At HCS, political correctness is never prioritized above God's unchanging truth. We hold the bar high as we prepare students to serve God's kingdom, not just the workplace of man. Affordable tuition and transportation options put the choice of Christian education within your reach.
Come visit the longest established Christian school in Harford County. You can become acquainted with us through a private tour or on the web at harfordchristian.org.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner professional from Akers Financial Group. We have offices in Lutherville and over in Farstill, over in Harford County. But we have clients throughout Maryland. We meet in different areas depending on what people want to do. And we're doing a lot of things over the video calls and video phone calls and just having a time of relating with people where they are and getting started in that way. Akers Financial Group works with Brookstone Capital Management as one of our third-party money managers. They're actually located in Chicago, and Mark lives in Chicago. Mark Diorio is our special guest today. He's the Chief Investment Officer of Brookstone Capital Management. He has a CFA, which I believe you know how to do some math. And we're going to start Mark out in the second half of our show on this really hot topic that's out there now, and that's ESG investing is a hot topic. And it doesn't stand for every stock grows. What does it stand for, Mark?
Well, although that would be great if that's what ESG stood for. But what ESG stands for is environmental, social, and governance. So this has come up a few times over the last decade or so. Sometimes you hear about socially responsible investing, SRI, and some other, or green investing. What this is really that combination of factors or issues and tied together into a comprehensive thought that you want to evaluate companies based on these issues: environmental, social, governance. So environmental, just what you think: pollution, waste, environmental opportunities, identifying companies that pose less environmental risk. In the same industry, you want to see those businesses that are really leading the way into best practices. Then on a social on the social issues, you'd look at how are they using human capital or their labor, product liability, social opportunities again, and also how are they treating all stakeholders. There's a theory, and it was very strong, from Milton Friedman from University of Chicago, and he has a couple of PBS shows or public television shows out there over the years. This was many years ago, but you can see it, some old clips of it. And one of his arguments was the prime purpose of a business was to pursue profits. And that got taken a little bit out of context, but that was the one line that really stuck with participants in the market, and that's the job of the company. What he was really saying is that's the prime purpose, but and if pursuing environmental, social, or governance issues was important to help you create a better business, then you would naturally do it. You didn't have to be mandated. But fast forward here several decades, and just the investor base has grown and is starting to put pressure on managements and companies to say you need to look at all these issues. We want to invest in companies that are leading forward and looking at all stakeholders. So those are customers, clients, employees, communities, as well as management and shareholders as well. And then governance, are they acting ethically? Are they looking at any corruption? And what are all their policies? Are they promoting transparency and so forth? But what's really important is that that as investors, we're allocating capital into businesses. And so those businesses and companies that want to attract capital, we'll find if there's more capital looking for ESG type companies that score high on these ratings, then companies are going to migrate in this direction because they'll have access to important capital. So that's how investors can really vote with their money, so to speak, and allow and say, I want to align my investments consistent with my principles or values. And so what we've really done is embrace that and say, well, that makes a lot of sense. We're seeing more and more investors take an interest in that and want to align or invest consistent with those values. And interestingly enough, when we've done the research and we've done a pretty deep dive into performance, you do not give up return. And that was one of the arguments a few years back. Well, you may give up return or potential return if you're eliminating some companies that may not be following ESG guidelines or best practices. And that's simply not the case. Actually, you actually get a little bit of outperformance over time. But the bottom line would be there's no evidence that there's underperformance relative to other investments like the traditional markets or traditional indexes.
So ESG investing, you're buying individual stocks and portfolios designed this way?
What we've really done was look at some of the largest providers of ETFs, exchange-traded funds. That's really the 21st century version of the mutual fund. Mutual funds are still very large and command the largest portion of the market. But with ETFs, there's a little bit more flexibility. And so the leader in sustainable, we call ESG investments or ESG investing sustainable as just a broad term, sustainable investing. BlackRock has been a leader, and they have the largest selection of ETFs, which are low-cost funds that allow access to all the different segments of the market. So you could really build a total portfolio. Previously, it had really just been focused on large cap stocks, but now we have large cap stocks, small cap stocks, international stocks, and bonds. And this is a critical component where you have, even on the bonds that you own, have been screened for ESG guidelines. And so you can create a full traditional portfolio, and generally we implement with ETFs because it's the most efficient way to get a complete portfolio of ESG investing.
So at Brookstone, you guys offer many ways of building portfolios and designing them. What are some other of your favorite portfolio designs that you've put together?
So one of them that's been very interesting, and we do something called some satellite allocations, meaning some areas that may be outside of your core portfolio model, but maybe you have a preference for, or maybe the opportunity set or the marketplace has allowed an opportunity to present itself in the market. We identified about a year ago, and have been talking about it since then, a suite of actively managed ETFs that focus on disruptive innovation. And they go along the lines of electric vehicles and autonomous and artificial intelligence, genomics on the healthcare side, and we've seen, and fintech, that's a kind of the combination of finance and technology. So we've looked at those themes, and so they'd be disruptive technology broadly would be what we call one of these thematic or theme-based portfolios or strategies that don't necessarily land in kind of a traditional definition of allocation, but they're really a separate segment. And so they're seeking out those companies that are really doing something different, that are looking to grow and come in to the market, that'll really grow into big companies in the next 5 years or 10 years. And the market usually want to be invested before that happens. And you can really get some good winners. And this year they've been in the right spot because all the change that's happened in the economy and the markets have really sped up that adoption of some of these disruptive technologies. And so that's really a fun area to be in. And a benefit to that is genomics is really that next generation of healthcare, where you have a large pharmaceutical kind of healthcare-driven market. The next one will be genomics, and that's just a very advanced. Genomics has been around for 20 years. But where the tipping point is for companies like that, or why we saw a big interest in that area, was because costs come down. So innovation is really about the decline in costs over time, not necessarily just the innovation. So to sequence the human genome, 20 years ago it cost $20 million. You come today and it costs less than $10,000. So you can do a lot more. So very fascinating type of the area in the marketplace. And we talked about dividend stocks. I still think that's a very interesting area, looking for income in this environment. And then we do something that most advisors really don't look at, which is something called structured notes, which has come a long way, and there's a little bit of a learning curve to go over. But they're an area to have a really different risk and return income stream from. So in an environment where we're looking to create more income because interest rates are going to remain low for longer, we keep looking at different areas, pockets of the market. So structured notes is an area issued by very large banks that just offer an income stream that you can't find in other places.
Yeah, I know at Acres Financial Group, we use Brookstone for many of these portfolios and try and design what's right for that client. We try to make it individual for the client, and we try to figure out what is best in their situation and how to apply it. So what we do at Acres Financial Group is we don't report to any big company in New York. We have offices that are throughout Maryland, and we meet with our clients and we talk about how they can win in retirement. You can begin that process by calling us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message. Susan will call you back on Monday to schedule a phone, video, or even a face-to-face or mask-to-mask meeting in the near future with one of our team of advisors. So give us a call at 833-946-7384 or visit acresfinancial.com or go to our Facebook page also. The country is going through phased openings. Will the stock market mirror those phases? We'll talk about this when we come back.
You are unique. Just as no two fingerprints are alike, each individual's financial situation is uniquely their own. That's why the Acres Financial Group's team of advisors begins each relationship with a proven process that identifies your financial fingerprint. We'll guide you through a series of steps designed to provide a complete and accurate snapshot of where you are right now. Everything we learn about your financial fingerprint will become part of a detailed financial plan created especially for you. We'll never give you a cookie-cutter proposal or suggest a one-size-fits-all portfolio. The financial plan takes you from where you are now to where you need to be. Begin by discovering your financial fingerprint right now by going to getmyfinancialfingerprint.com. That's getmyfinancialfingerprint.com.
Member FINRA SIPC.
Are there times in some games you wish you could just turn on the TV at the 2-minute warning? Because that's the most important part of the game, right? As a fan, these are the most exciting moments. Your team could take home the victory or crumble under pressure. But when it comes to your retirement, don't wait until the last 2 minutes. So much can happen in the final working years before retirement. Whether you're in your 50s or 60s, near or already in retirement, there's still time to put a plan in place. Don't wait until right before you retire to begin planning for your future. Can you win the retirement game like that? Come in and talk with the team at Acres Financial Group. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC. Imagine you're retired. You wake up in the morning and you don't even know what day it is. Every day seems like a Saturday. You can sleep in, cook a nice full breakfast without thinking about morning traffic or work deadlines. The Saturday calmness you used to crave is now your everyday feeling. You're not worried about your retirement income or how your investments are doing. Your biggest decision that day is where you're going to drink that first cup of coffee. Is that the kind of retirement you want? If it is, then sit down and talk with the team at Acres Financial Group. They want to help you get there. They've been helping families in Maryland plan for retirement for over 30 years. Call to schedule your complimentary meeting at 833-WIN-RETIRE. The number again is 833-WIN-RETIRE. Start planning for your retirement now. Call 833-946-7384. Member FINRA SIPC.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, Certified Financial Planner Practitioner at Akers Financial Group. And here with me today has been Mark Diorio, Chief Investment Officer of Brookstone Capital Management. At Akers Financial Group, we invest our clients' money in privately managed portfolios. These are managed by different designs through third-party management. We work with these managers. Mark Diorio is the Chief Investment Officer of Brookstone Capital Management, which helps us deliver this to our clients. This show is recorded, of course, and that recording actually will be on our website by Wednesday of next week. So at acresfinancial.com, you can go to our radio tab and you can hear a recording from last week or last month. You'll see all the different topics. You can hear what we've been saying throughout this year, throughout all the changes that have gone during this virus time of our life. So what I got to do now is I got to bring up a lot of things with Mark here. And this fourth quarter is tough. We got to finish strong. All right, Mark, the country has been going through phased openings. Will the stock market do the same thing as phases? What was going to happen here as we face the rest of this year?
I think we've had a great bounce in the markets based on the policy response, as mentioned earlier, from the monetary response that comes from the Federal Reserve. So they put in liquidity into the market to help smooth out financial conditions, and some of the stimulus efforts from the Treasury and Congress. So I think the market short-term responded to that very acutely, but it's going to quickly have to turn its attention to the realities of the economy, which is a phased reopening, which will take time and take time for earnings to recover. So a lot of times economists talk about the shape of the economic recovery looking like a V, meaning you drop down real sharp and bounce right back up, or a U-shaped, which is just like it sounds, just takes longer to recover. Alternatively, you might hear the W, which is it drops down, comes up, drops back down, and comes back up like a W. We had that in the early 80s with the kind of a double dip recession, or even an L-shaped recovery, meaning the economy drops and then just stays at that output level for quite some time. Our base case is for a U-shaped recovery. We think the policy response has been necessary in the short term to satisfy financial conditions, or at least smooth out financial conditions. However, the markets will probably be battling this idea that monetary stimulus came into the market, which took out the worst case scenario, but then be tethered on the upside, or at least in this range, because earnings aren't necessarily going to, or earnings are going to be a little bit challenged here for the next several quarters. So we think it's very much a range, and maybe even a volatile range going forward. History has shown that markets that start out very volatile, and this has been one of the most volatile years in stock market history, tend to stay volatile for the rest of the year. And I think one of the points that you made at the end of the last segment was you're building portfolios that are appropriate for individuals. And the key word is appropriate. You won't know what the best investment was until hindsight. And you're likely, in your pursuit of trying to get the best investment, assume a lot of risk to do that. And there's no real ability to tell you that or quantify what your chances of success are. Whereas if you build a portfolio that's appropriate given your situation and balancing the trade-offs between volatility and inflation risk and overall return and achieving your goals, I think if you stick with that mentality and that approach, that disciplined approach, you're going to be able to make it through whatever the market gives us in the second half of the year, which isn't necessarily negative or overly positive. It's just we got to get through 2020, and a diversified, disciplined approach, we're highly confident will get you through.
Well, there's a lot going on this next 6 months. We have an election, which we really haven't spent a lot of time on it when you look at the economy of the next election, but that will affect the fall, right?
So in the short term, and when we've looked at election statistics, and in fact, going into this year, that was one of our main statistics, looking at the election as being a big event for the market until everything else happened. The first half of 2020 happened. But what we find is there's really no discernible evidence that you get too much of a stock market impact based on the election. Now, there's a lot of narratives around that and each party will use their own narrative that if you elect this person, this will happen, or that person, this will happen. But what the objective data shows is that 83% of the time in an election year, stocks have ended positive, and they look just as normal as any other year. You wouldn't know unless you put these are the election years going forward. So although I think you'll have some hesitancy and maybe some market headlines that it's cautious ahead of the election or it responded to the election, really the stock market overall will react to the monetary and economic conditions over time and adjust appropriately. But you will have some short-term, I think, impact, especially where we have this year where you have maybe some unique circumstances around voting and how that takes place.
Yeah, I was just trying to think about when people have money to invest and they think, well, it's an election year, maybe I should wait to after. And people are thinking about when to enter this kind of market. In a volatile market, my general answer is to be constantly investing, to consistently invest, maybe some money every month, every quarter, and try to buy into this volatility. You're never going to pick a low. What's your opinion of trying to pick a low over this next 6 months?
Yeah, I think that can, especially how fast the market is moving, and it will be moving fast, and you could be seeing big moves. In the first half of the year, we saw a lot of big moves very fast. Nobody is catching those big moves like that. It may look easy. It just doesn't happen like that. The markets are just moving very fast. So you could have all the intention to wait, but then miss that turn. And missing the market is really devastating. If you look at any long-term study, or even over the last 10, 15, 20 years, you would say, geez, if you miss just the 10 best days, your return drops by half. And if you miss just the 30 best days, you're basically flat over that time period. And so it's really critical. You don't know when the best days will happen in the market, but they do happen. And the market rallies pretty sharply. I remember having a number of calls when the market was dropping in late March and mentioning that, yes, the market dropped by this much. At the time, it was 1,000 or 2,000 points on the Dow, big round numbers. So at some point, the Dow will also rally 1,000 or 2,000 points in a day. And sure enough, we saw that. There wasn't a prediction in the sense that predicting it. It was really a grasp of market history saying this is what happens during these volatile times. You'll have volatile down days and then just as quick volatile up days over time. And so you could really create more challenges for yourself by outthinking or try to outsmart the market. I would agree with you. you have a plan in place, execute the plan, and you'll have a lot greater opportunity for success.
Now, our radio show is called Winning in Retirement. What are some key investments people need to own as they enter their retirement?
I think they have to be careful about not getting too conservative with their investments, because traditionally you'd go into bonds, but bonds are paying very little right now. That doesn't mean you'd go away from bonds. They'd be part of an overall portfolio, but it doesn't. But what it's telling you is don't just reduce stocks to reduce stocks or eliminate stocks from the portfolio. I think you still need a mix or a balanced portfolio to get through the next several years, because the key is understanding volatility is a short-term risk, inflation is your long-term risk. So the preservation of purchasing power, to me, is really important. And then as you're building a portfolio, balance those two consistent with your risk profile and your goals. And going back to the probably the most important word, which is building what's appropriate, the appropriate portfolio for the individual.
All right. I thank you very much, Mark, for going over the market with us today and covering a little bit about the portfolios that we use at Brookstone Capital Management. Brookstone Capital Management has a lot going on. Recently announced a merger where their under management will be over $6 billion? Is that true?
Yep. The announcement came out about $6.5 billion. So we'd be one of the larger, interestingly enough, we think probably about in the top 40 independent RIAs in the country.
Congratulations to you and all the people that lead Brookstone Capital Management. And thank you for coming on our show today. We'd like to thank all those that are listening to Winning in Retirement. We try to take people from where they are. We call that your unique financial fingerprint. We look at where you are and we try to help you go to where you need to be. And that's a process of financial planning and a process of implementing that plan into investments and insurance and estate planning and budget and tax planning, bringing it all together to design your own personal financial plan. And then we work with our clients on an ongoing basis. Retirement shouldn't be about lots of stress, a lot of worry. It should be about things are taken care of. The complex topics like we talked about today are made simple and handled by the experts, the advisors at Acres Financial Group. If you'd like to find out more about us, you'd like to sit down and talk, or you'd just like to give us a call, you can call Acres Financial Group and begin winning in retirement at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave a voice message, and Susan will call you back on Monday to schedule a phone or video meeting. We look forward to when we can come in and see us. Honestly, we prefer to do that without face masks, but we're even doing it now with masks. So give us a call. Start planning your retirement now at 833-946-7384, or visit acresfinancial.com or go to our Facebook page. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
Are you reacting or creating with your investments? When you have a sound financial plan, you don't have to be reacting every day. Let us help you create. Tune in to Winning in Retirement Saturdays at 11 a.m. on 105.7 The Fan. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated, member FINRA SIPC, and investment advisory services offered through Kalos Management Incorporated, both located at 11525 Parkwood Circle, Alpharetta, Georgia, 30005 678 1100. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services.
Acres Financial Group was founded on the principles of integrity, trust, and service. We believe each and every client is unique and deserves advice and implementations that apply directly towards their personal financial fingerprint. This financial fingerprint tells us the objective risk tolerance and purpose of the investment and insurance tools that we use to assist our clients in reaching their goals. By discovering the purpose of each financial decision, we can help you accomplish your goals. Intelligent financial design starts with a detailed balance sheet and cash flow to know where to start. This leads to a financial decision that will allow you to reach your goals with your risk tolerance in mind. Our relationships begin with an initial consultation and grows with each meeting. We would be thrilled to work with you and begin your planning process. Call us at 833-WIN-RETIRE. That's 833-946-7384. Or visit our website at acresfinancial.com. Member FINRA SIPC.
Hi, this is Jesse Cunningham, the owner of Mountain View Insurance. and we are proud to be affiliated with Acres Financial Group. We, too, base our business on integrity, service, and acknowledge that every client's insurance needs are unique to their own situation. At Mountain View Insurance, we specialize in car insurance, home insurance, and umbrella coverages, all designed to protect your assets that you've worked so hard to earn. When serving our clients, we focus on creating a protection plan that is appropriate to your needs. After we determine the correct plan, we then go to shop for you. Mountain View Insurance is an independent insurance brokerage, and that means we have access to many top national and regional insurance carriers. Let us build an appropriate and affordable insurance plan for you, and give us a call directly at 410-262-3176. Once again, that's 410-262-3176. This is Jesse Cunningham, owner of Mountain View Insurance, and I look forward to hearing from you.
The preceding was a paid program, and the views expressed on this show do not represent the views of WJZ-FM, Entercom Communications, its sponsors, or affiliates. Broadcasting from the Thompson Creek Window Company studios. High-quality windows at an affordable price. Direct from their local factory. This is WJZ-FM Gainesville, Baltimore. 105.7 The Fan. A Radio.com sports station.